Should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back. Oh, man, I'll be glad when these elections are over. It's just, it's draining, watching all this stuff. But good news is, economy's in good shape. You're always going to struggle in some area, by the way. I mean, there is always struggle in some area of an economy. But when the unemployment rate's not over 10% the way it was when I was just getting out of school, and inflation was double digits, it's pretty good. I compare it to that, and it's pretty good. We live a lot better life now. Overall, the amount of effort that it takes to live a normal life is not as much as it was when I was a young man. Yeah, because you had to do a lot of things by hand. Nobody knew what the internet was. It didn't exist. So if you wanted to look something up, you had to wait till after work to go down to a library somewhere, and hopefully they would have the material there. If not, you'd have to talk to a librarian and try to get the books in from other libraries. That might take you a couple months just to look up the answer to a question. Now all you do is come in and actually you can talk to Google now. But most of us still like to type it in and read. And it's just mind-boggling when I look at all the changes that have come. And you know what? They're still going to come. There's a lot of work left to do. We're not even remotely close to where we're going to be in the next 10 to 20 years. So I think people forget that when they start looking at economies and stock markets. They're looking at things as they are right now, as if it's going to stay that way, or it's going to stay on that current path, whatever that path is, forever. So they have it. The general public has a tendency to get overexcited when things are going well, and overly depressed when things are not going well. And so I guess you can't program that out of the public. So it's you just have to learn to deal with it. And I'm telling you, the economic indicators are all, they're not the highest they've ever been by any stretch of imagination, but they're also nowhere near the lowest. So I kind of like it here. I think stocks are reasonably priced. I think interest rates are actually somewhat reasonable. I didn't, even though I benefited dramatically from lowest interest rates that we've seen since World War II in this country, before most of us were born, actually a long time before most of us were born. I thought it was pretty good at that point in time. I was able to pick up some property and pay my interest rate on it. I'll probably never see that again in my lifetime. It's only 3%. So happy to be there. All the properties around where I bought that property they're not having any problems selling. In fact, several people on the street have sold in the past year and a half, and one of them put just a sign in the front yard. I looked to see if they had listed it anywhere on an MLS, and they didn't even list it. And I couldn't believe how many people were driving by, and that house they sold it in about a week and a half. Uh, Mind-boggling. So I'd never seen anything like that before. And so when you hear all this negative news, just remember um, things are a lot. Negative news sells. First of all, I remember in journalism class way back in high school, and I took it in college too. And there was an old saying: "If it bleeds, it leads." And they would kind of say it tongue in cheek, as if nobody were actually using that. But realistically, it's more today than ever because they've got to try to get your attention. If they can't get the attention, if you don't click and watch the video, or if you don't read through, or you don't spend a certain amount of minutes on a web page, uh, the wedge page sponsors don't get paid. They don't sell products, so it's interesting. That part is super interesting. It's mind-boggling to me how much time, effort, and energy goes into that stuff, and it's not like that's going away anytime soon. In fact, I'm marveling at the TVs. I've got one of those great big monster TVs, but I always buy one that it was the best like a year and a half to 2 years ago. You wait for an upgrade to come, and then you go in and buy the the best from the one that's just going out because you avoid getting stuck with a really high prices on it. But it's pretty funny. Yeah, and just looking at all the various new industries that are growing. I spent a lot of time in the greater Columbus area, and wow, um, mind-boggling. I spent a lot of time on the east side of Cleveland. There's a ton of building going on over there, and they're building these really expensive condominiums and housing developments. It's pretty good. I just can't imagine things being a whole lot higher if things do continue to heat up. You'll probably see interest rates start to creep up, but right now it looks like they're actually cooling off, which presents another type of problem. If you were waiting to uh, invest in fixed income or upgrade your portfolio, then they're not way too late. I use a fund for a tremendous amount of my fixed income in my own accounts, and I don't care what age you are. I think that fixed income's harder than it looks, and this fund's done extremely well by me. I've been using it forever. Right now, the fund that I'm using is yielding a little over 5%. That's pretty good. The average maturity in the bonds in there is right around a year now. It's right around 1 year. So the fund is being actively managed. It's short term. It's designed to produce income. And you know what? When I need something that's going to be relatively liquid and is not going to drop by 50% every once in a while, then that's my go-to fund. If I know I'm going to need the money and it's less than 2 years from now, I use a money market fund that's available to us. It's also paying around 5%, a little over. And if it's money like if I know I'm not going to, let's say I'm 62, I'm going to try to retire at full retirement age, which is 67. Okay, then I might take the fixed income and invest it now, defer taking money out of it, and not have to pay taxes on the income, the growth that it's getting. That's you can only do that with one product, by the way, and it's an annuity. And oftentimes I'll say that, and a lot of people are really turned off by annuities. Normally it's because they don't understand the newer products that are out there. And I mean, there are literally thousands of annuity products. It's probably in the tens of thousands. And there are all different types. Some of them invest in the stock market, some of them don't. Some of them have guaranteed income, some of them don't. You take a combination of various um, time periods that they will guarantee interest on. They'll guarantee the amount of interest that it grows by that while you have it. The tax deferral, it's a lot, you know. So it's really a lot. And I just got back from a 3-day conference where this is all they talked about. In fact, they were only talking about fixed annuities and didn't even get to the variable part at that point in time. And at this stage of the game, I think I like the fixed product. I think it's going to be incredibly difficult for variable products over the next 4 to 5 years. There's a good chance that the fixed annuities end up outperforming the ones that your stock funds. Um, Most of the funds that are available now to the general public are also available in what's called a variable annuity. That's kind of like a 401k plan in that you got this wide array of choices, a bunch of different fund families in there: Fidelity, Vanguard, BlackRock, Putnam, yeah, you name it. It's in there somewhere. Somebody's got a product that's got funds from one of the major fund management companies in there. That's one of the things that makes it really confusing too, and they're constantly changing. It's like every quarter, like probably 15 to 20% of all the annuity companies out there, and there are a lot of them, are making changes. They're coming out with new products. So every quarter, you're just like, I have to go through and read all that, and it's interesting to a certain extent, and it's just a lot of work most of the time. So if you're interested, and this is what interested me, I started looking at it a couple of years ago, knowing that I've got about 6 more years, and I'll be eligible for Social Security. So 6 years, I want to have a certain amount of income. I have a general idea of what that income needs to be over that time period. So I just put enough money into an annuity so that between the annuity and my Social Security, I don't have to worry about living. Everything else I have, I'm just investing in the same model that I use for my clients. And so it works out. Now all I have to do is stay alive. But which might not be that easy. I mean, you never know. But and I take into account, what could potentially happen. What if we get another big correction that takes the market down 30-40%, takes it 3 or 4 years to recover? When you look at the entire time period, it could be anywhere from 5 to 10 years. What would I do in that environment? Well, I probably wouldn't spend any money out of that account that it's got the stocks in it that I'm looking to supplement my base income, which is enough to live on. And by the way, that's not always possible for everybody. This is one of the things I have always felt strongly about. I think they should start teaching this in the 6th grade, because by the time you're in the 6th grade, you already know enough math to be able to do this. You do, especially today. And the kids today, they are growing up on computers. This should be shown. They should start teaching basic financial planning to 12-year-olds, because if you don't get to them before their hormones kick in, you can't talk to them until they're in their 30s. But anyway, I'm just kidding, kind of. But the younger you get them, and the younger you plant that seed, and you don't have to try to scare them or anything. But here's what this could potentially grow to. Here's how much you need. I think that should be done right around the 6th or 7th grade. And because again, they can understand the math, and for the vast majority of them, it's a little easier to talk to a 6th grader than it is to a senior in high school, if you know what I mean. And so get them when they're young and impressionable, and get them working on it and thinking about this stuff. It's important. It's unbelievably sad to see the environment for retirees in this country And there's no reason for that. This stuff should be being taught in schools when kids are really young. Just incorporate it, because at some point in time, they're going to need it. It's um, I don't know what the word is. Disturbing, I guess. It's very disturbing to see the average worker today, or the average small business owner, getting ready for retirement. They really don't know what to expect, and I'm thinking to myself, "Wow, I was lucky to have picked this field as a career choice, because I'm not sure I would have known. I'm not sure anybody would have said anything to me about it, and it's kind of a big deal. It's a really big deal. So how do you meet those income goals that you have? Normally, people are they're looking at income producing investments, um, the bonds, CDs. That's the one that come. CDs typically come to mind of most people. And you know what? I just got a clue that I've got about 60 seconds before I got to take a real quick commercial break. So let's hold these thoughts. This is Bill Bullington. I'm right here every Saturday morning from 11 to noon, 1420. And I will talk to you guys again in a couple minutes.
Sometimes sorrow is the door to peace. Sometimes heartache is the gift I need.
Bob France here, and if you are dealing with a leaky roof, we should probably take care of that sooner rather than later, don't you think? Quick call to Sky Roofing will get it done. 440-349-6750. Look, there are a lot of roofing companies out there that want your business, but this isn't something you want to trust to a fly-by-night company. Sky Roofing is in it to stay. They've been serving Ohio homeowners like you and me for 24 years. That means they're doing it right by the roofs they repair, the roofs they replace, and the people that they serve. The pros at Sky Roofing have pledged to treat your roof like it was one of their own homes. So if your roof is in disrepair, maybe you've got some gaps in the shingles, call Sky Roofing. And if your roof has been good to you, but it's just that time that all homeowners face and you have to replace it, call Sky Roofing. Check out their work and the testimonials at the user-friendly website skyroofinginc.com. Then make that call, 440-349-6750. Call today, get a great quote, and treat your roof the way you need your roof to treat you. Sky Roofing is roofing done right.
Wish there was a place to find good, clean, family-safe entertainment? A place with no violence or profanity? Where you can let the kids roam free? That place is the all-new GodTube.com. Watch inspirational videos that'll challenge and motivate. Catch the latest music videos from Christian artists like Jeremy Camp, Hillsong, and Chris Tomlin. And share a laugh with clean comedians like Tim Hawkins, Anita Renfro, and more. All free 24/7 right in your own home at the simple touch of a button. Visit the new GodTube.com. That's GodTube.com.
No doubt about it, we're spending more time at home, which is the perfect time to make it more functional and beautiful. Hi, Ed Flash Ferentz here for Artistic Renovations, Northeast Ohio's premier and award-winning remodeler. Artistic did a fantastic job with our kitchen in 2016, and last year, they were back for the master bath. Oh, my word. Do yourself a favor and go to artisticreno.com. Believe me, you'll love their ideas and without question the finished product. For a virtual consultation, call 216-520-0838 or visit artisticreno.com.
Thinking about updating your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit joycefactorydirect.com.
Welcome back. Oh, man. What a day. The weather is beautiful. Yeah. Glad to be alive. Yeah. Um, yeah, we're just talking about some fixed income opportunities there. Bonds and CDs are actually pretty good. We use the Fidelity for it's our primary custodian, Fidelity. About 2/3 of the assets that we have is there. I also like Axos Bank. They're the largest online banking company in the world. the fixed income department's not as good, but their ability to manage portfolios there, you can actually do some stuff that you can't do at Fidelity or any of the other major custodians for that matter. They were slightly ahead in that phase. If you're really if you're not really young, it's not going to matter because they're for the aggressive people. So, but the vast majority at Fidelity is the best. And in fact, the really aggressive stuff people forget. You know, the higher returns that you want to make, the more aggressive you have to be. You can't get the big returns without the risk. And when I tell people that, when I say that, especially on the radio, I know there are some people reaching for the dial and changing the station because somewhere out there somebody's told them that it's easy to get high returns with little or no risk. Yeah, let me explain something to you. Warren Buffett is the best, or has the best long-term track record of nearly anybody on the planet, which is amazing because the guy's been dealing in billions for a long time now. Billions are a lot harder to manage than a couple 100,000. Okay. And he started at well under a couple 100,000, but he had a great track record. He also had big drops every once in a while. He was down 50% multiple times during his career. So my point is that if one of the best that ever lived can't do that, can't generate those big returns without incurring a lot of fluctuation, he doesn't even consider it risk. He's just, the share prices are moving, and that's one of the reasons he's been so successful. He knows that a business that's producing a whole lot of cash, how do you know? Well, because you look at the financial statements to find out. I can't tell you how many people don't even look at financial statements. They just listen or read stuff online, and they never look it up. So anyway, he knew that the prices on those companies would fluctuate and would get out of whack, both to the upside and to the downside. So he would wait for the companies to get undervalued and then buy them. And it wasn't uncommon that they weren't done going down. He'd be buying them, and then they would still go down. And by the way, not just him. It's every famous portfolio manager that's ever lived has lived through the same stuff. The bottom line is nobody bats 1,000. Okay, like has there ever been a Major League Baseball player that's ever batted 1,000? No. In fact, if you can hit 1 out of 3, you know what they call you? A multimillionaire and an all-star. 1 out of 3. And that's what I thought was so funny when I first was learning about this. I'm reading all this stuff that you get now. It's all online, and it's BS. You know, the best long-term performance of most investment managers is also going to have the most fluctuation up and down. And every time I say that, there's some yahoo that wants to argue with me. Well, just save your breath because you're not going to convince me the same way I'm not going to convince you. And that's okay, and it's fine. This is America. You are free to have your own opinions and to go about your own life doing that kind of thing. But I'm just telling you. Why am I telling you? Well, first of all, I manage money. I have money in the market. I'm managing my clients' money very similarly the way that I'm managing mine. Why am I doing that? Because I think it's the best way to do it. And it's that simple. Yeah, and does it involve a lot of individual stocks? Not anymore. I mean, it used to. In fact, I used to run models. There's at least a dozen models out there where they've just barely made a change just to call it new, and they can go out and market it themselves as something that's relatively new. And you know what? Some of the changes are actually meaningful. Sometimes there are things that a big firm is going to be able to do that you or I, as small investors, are just not going to be able to do. And in most cases, the vast majority of the general public's not going to have time to do it. And now that I've been doing this for as long as I have, and I'm taking care of clients every day, I don't have time to do it anymore in my own account. But it's a good thing that I learned how to do it, what to do, what it takes. I understand how difficult it is psychologically. Mathematically, not so much. It's the psychology behind it. And I know that the funds that I've chosen are doing the same thing that I would be doing if I were still small enough to be able to manage individual portfolios. Okay. So that's why I picked them, by the way. And yes, there are certain things that do matter more than others. They like to call them factors. The and the factors, by the way, that are going to have the biggest impact on your stock portfolios over time are size, uh, and this is it doesn't work like it used to. There's some. This is a super long. This would be the subject for 3 or 4 shows. So I'm just going to tell you that size has a tendency to matter. The smaller companies typically are growing faster, but it may not always turn into better returns. Oftentimes it doesn't, okay, which is totally counterintuitive. I get it, but anyway, size, speed, how fast is it going up? The how fast is the share price going up? The share price times the number of shares. Let's say they have 1 billion shares and the shares are at $100 a share. Okay, that's $100 billion market value. They like to call it market capitalization for that company. The and I'm just assuming the company has no debt. But is that very meaningful? Not by itself, but if it's rising, that's meaningful. Meaning last year, if it was $90 and this year it's $100, well, it's up 10%, or more than 10%. And that's a good thing. So that's something that's going to be factored in. That's one of those factors. Is it growing? If it's not growing, it's going to fall down in the rankings and probably won't make it into the portfolio. And I know a lot of people say, well, you're going to give up on it because you have 1 or 2 bad years. No, it's going to be reduced. It may not be so bad that it actually gets kicked out. It depends on how it ranks. But if it does need to get removed, then it needs to be removed. And this is why the funds have a tendency to do better than people do, because they're running it just based on the numbers. And when the company's numbers have fallen out of the top of their categories, the stock gets put away. If it turns around and starts coming back, and this is what the average investor never thinks about, that company starts to improve again, they'll put it back in. But I know the vast majority of individual investors just don't have the guts to do that. They don't have the time either. And in fact, I would say that it's more of a lack of time than it is the courage. I guess a lot of people today they're just more sophisticated than they used to be. And but having the kind of time. So understanding what you're investing in is a big deal, because it'll give you the calmness and the confidence to go through the market gyrations that we've been going through for our entire lives, and that our great-grandparents were going through if they invested in stocks. Yeah, it really hasn't changed all that much. And I don't like to, a lot of people like to think that, well, it's a lot faster now. Really? You need to go look at some stock charts from the late 1800s. I'm telling you, the late 1800s. Those stocks were flying. Yeah, both directions, by the way. So the more it changes, the more it stays the same, I think. Anyway, what causes share prices to rise? Well, it's the expectation of future sales increases and profits that go along with that, hopefully. And well, you got to predict which ones? No, you don't need to predict. You need to observe what's happening right now. It's one of the reasons I've been talking for the past several years about healthcare and semiconductors. Those are my 2 favorite industries outside of a broadly diversified fund that's concentrating on companies who are growing faster than average. Those are the types of funds that I like. Those are the ones I use for my clients. Those are the ones that I use personally. I like the funds that focus on the sales and profitability. Why? because it makes sense. And if you look back in the long run, and that's by more than 10 years, incidentally, long run's not 6 months from now. I can't believe people are. I don't get that very often. It's probably because people are listening to my show and I make fun of it a lot. But the reality is that long term is a 10-year time period. That's long term investing, and every time I make an investment, that's what I'm thinking. Am I willing to stick it out for the next 10 years? If I'm not willing to stick it out for the next 10 years on this, I'm not going to make the investment. I'm just not going to do it. Yeah, and neither should you. If you can't put the money away and say, look, I'm going to hang on to this for at least 10 years, I just wouldn't do it. And a lot of people come up and say, well, yeah, my kid is 12, though, and I got to take the money out when he's 18. That's only 6 years. Well, don't put a ton of that money into stock funds. I would hate for you to have your kids' colleges, and I know they were disrupted in the year 2000 when the market peaked, and over the next 3 years, when it finally stopped going down, it was down over 50%. Think about that for a second. You're really going to put your kid's college on hold for 3 years because you had an allocation wrong in your investment portfolio? That's not good. So you've got to see that. You've got to expect that and only have as much in there as you can possibly stand. And really, you need to look out over a 10-year period and figure. I like to use the 50% drop as, hey, that can happen. And like I said, it happened twice in one 10-year time period since I've been alive. And I'm not that old. But so it's a lot of common sense stuff after you've seen market trends, after you study them for a while. I can't tell you how many new advisors and people that are coming up through the system. They have to learn the hard way, by the way. You'll only hear me take this tone of voice on my radio show. This is where I let my frustration out. The rest of the time, I try to keep it nice, keep it easy as I can, and showing somebody a long-term chart, of the stock market is we're going to do it. I'm going to do it, and yeah, it means that a lot of people are going to come into my office. They're going to see the long-term chart, and they're going to go, "Wow, that's not what this other guy said or these other people said," and what they said sounds a whole lot better. Yeah, it's because they're leaving this out. My feeling is that, you know what? Eventually, you're going to find out anyway. You know what I'm saying? You're going to live through the next time period that's difficult for stocks, whether you like it or not. Okay? And I would rather you be prepared for that than not be prepared and because when you realize that, somebody either didn't know any better or they didn't want you to know any better, and they, in the old days, we used to say sold a bill of goods. Yeah, basically, they just didn't disclose everything they should have disclosed to you, and you might have changed. You might have taken a more conservative route. I don't know. Maybe it wouldn't have made a difference, and you'd have stuck to it. That's basically what I did and am doing. I know that if the market drops by 50% or so, I'm going to be down around 30%. No sweat. Why? Because I got 65% of my money in stocks, which is, by the way, the lowest allocation I've ever had. I just made that change a couple months ago. Prior to that, I was actually 75% stock. And I just got thinking, you know what? I've been through this quite a few times. I can take the 30% decline, but it's hard when it gets to 35 or 40. That's I'm getting a little bit old for that, just a little bit. But and I know some 20-year-olds that are like, "What? I can't do that." And probably shouldn't be doing it anyway. I mean, you're young and you have a family. Everybody likes to oversimplify just about everything. I shouldn't say everybody. There's a large percentage of the population who's always looking for a shortcut. There's this one rule, and if you just use this one rule, yeah, you know what? That's not the real world. The real world is you have a risk tolerance. It's almost built into your DNA. I firmly believe that. There's some people who just handle risk significantly easier than others. They manage it. Because in your head, when you see those investments dropping, you can't tell me that's not. If it's not stressful, you're just not wired like the rest of us are. But and everybody reacts to it slightly differently. And this is one of the reasons I think that the role of an advisor is not really going away. I think you need people to talk to. You need people to be able to go over remind you why you're doing what you're doing. And it's one of the reasons that, professional sports have coaches. Think about that. By the time somebody's reached a level where they're professional in any sport, I don't care what it is, they still have coaches. You know why? Because in the heat of the battle, even professionals have a tendency to get flustered and make mistakes. And they look over at the coach, and the coach reminds them what they're supposed to be doing, tells them to calm down, breathe deep. Not that they don't know that they're supposed to be doing that, but occasionally you need to be reminded of what you already know that you're supposed to be doing. And then you're like, oh, yeah, okay, I got it. And so I'm actually pretty glad that I played a lot of sports, competitive sports. It's really helped. And when I was raising my kids, I tried to get them to participate in competitive sports. And if they didn't like it, I didn't push them. No, that's okay. You can do something else. And they all found something. But, like I said earlier, I think they should start teaching this to kids. When they're about 12 years old, they know pretty much all the math. And I've only got a few seconds before commercial break, so I'm just going to let you know that this is Bill Bullington. I'm here every Saturday morning from 11 to noon, 1420. Going to take a quick commercial break here, and I'll be back right after these messages.
Lately I've been reeling, watching the nightly news. Don't seem to find the rhythm, just wanna sing the blues. Feels like a song that never stops.
It sounds like an oxymoron.
Who you calling a moron?
Not moron, oxymoron. Like jumbo shrimp, minor crisis, or exact estimate.
You think advanced technology plumbing is an oxymoron?
Yep, it's tech that lets us line customers' clay pipes with advanced epoxy.
Without digging up their yard.
And guarantee the results for life.
The equipment even uses advanced light wave curing and robotics.
And it really is advanced technology plumbing.
Which is a big deal when the old-fashioned method requires tearing up your yard.
Or jackhammering your driveway.
Now that's a minor crisis.
I see what you did there.
Fortunately, we can do better than an exact estimate.
You're killing me, Smalls.
We provide guaranteed upfront pricing while saving your yard.
It'll also turn a week's worth of disruption into a one-day job.
Wyatt Works pipelining makes the alternative look positively moronic.
So choose oxymoronic instead and
consider it done at WyattWorks.com.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit JoyceFactoryDirect.com.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. And I feel kind of bad. I was going to talk a lot more about annuities. They're getting to be more and more popular. I mean, the popularity has always been pretty good. But over the past few years, tons of people are looking at them. And I get it because you can get guaranteed rates of one of them I'm looking at right now is 5.6, and they're talking about guaranteeing that for multiple years. That's pretty wild, because 5.6 that's above long-term average of the 10-year Treasury for the past 100 years. So the insurance company's taken on a fairly significant amount of risk to make that guarantee available. And that interest that you're getting can stay in the annuity and compounds, and you're not getting a 1099. So it's growing, and the growth that it generates is growing, and it's all tax deferred. You don't have to pay taxes on it until you start to take it out. And even then, there are some techniques you can use to actually turn income on. If you do a straight life, like what that means, let's say I don't have any beneficiaries, I'm by myself. I have a lot of clients like that, actually. And they don't really need to leave any money to someone else, so they just take as much as they can get. That's the highest level. That's life only. Okay? That'll give you the highest level of income that you could get. The next highest one typically is a life with a 10-year certain time period. That means they're going to give you a guarantee for the next 10 years. And if it's only 10 years, at the end of that 10-year period, it's over. That's one of the reasons well, it depends on the insurance company, by the way. I should tell you that. Minimally 10 years. So if you died, they would pay somebody else for 10 years, or they would give them a lump sum. It really depends on the product. I almost feel like I just opened up a can of worms here, because this area is complicated and it's constantly changing. So you got to have an idea of what you need. If you're looking for something that's just similar to a tax-deferred CD, okay, those are pretty good. The internal expenses on those are lower, so they have a tendency to have a higher interest rate. If they're not making a promise to your beneficiaries or your family, it doesn't cost the insurance company as much, so they can pile up more interest for you. And every situation is a little bit different. And I would just, if you're interested in looking at, say, what kind of options could I get, the thing you need to think about is, do you need to provide for someone else? Are you married? Do you have a spouse that you'd like her or him getting to continue to get the income? Do you want them just to have a lump sum? If you both happen to pass away at the same time, would you like the kids to inherit after that? There's a lot of stuff here, and it's literally it's estate planning. And I'm in contact with a couple of estate planning attorneys, because this stuff can get pretty complicated pretty quickly. So actually, this life is complicated anymore in setting up your accounts, making sure that if you don't have them as a trust as a beneficiary, and the trust has really good instructions that are going to carry out your wishes even when you're not here, then do you have the beneficiaries set up the correct way? There's a lot. And is this going to be protected from a nursing home. If I ended up having to go into a nursing home, their nursing homes are really expensive. They expect you to spend all your money before you get aid from Medicaid, and which is the agency that pays for nursing home care, but only for people who can't really pay for it themselves anymore. But there are some things that you can do to protect your assets if you want to leave a legacy for your kids. So the one constant that I thought I was being kind of funny when I was young, and I was doing this program, and I would say the only thing that is constant is change. And I thought, yeah, that's pretty clever. The pretty cute, and people probably get really sick of me saying that in a relatively short time period. But you know what? It is more true today than it was when I started doing this show more than 20 years ago. The changes that come down, it's just mind-boggling. And it's a lot. I just, if I didn't do what I do for a living, I'd look for somebody that did. Because there's just a lot of things that you have to pay attention to. I mean, you don't have to. I mean, you can go without a plan and, just let everybody fight for themselves, and that's basically what they'll be doing. They'll be struggling, and but I think it's better off to have a plan, and it doesn't have to be super complicated. That the first thing that you have to decide is what do you want to have happen, and that's not easy. That is not an easy choice. And oftentimes somebody will sit down talking about what they want to do. Where do you want your money to go? Um, how do you want to be? How do you want it invested along during your lifetime? And it gets overwhelming. I understand. It gets overwhelming. So, and some people, quite frankly, they just can't. They have so many accounts scattered in so many places to be able to organize that in your own mind. It's nearly impossible when you're young and you have a really good memory. So there are tools out there that allow you to look at that. And realistically, I mean, if you're in the millions, I mean, multiple millions, that's going to be pretty complicated. But if you're like under 10 million, if you're under 5 million, it gets a little easier. The smaller that you get, it just gets easier. But you have to have some idea of what you'd like to have happen. And that is the sticking point that I come to almost each and every case where somebody is looking to be organized. They come in and they don't have a really good idea of what they want to have happen. And they've heard a whole bunch of stuff. They've read a bunch of stuff that confuses them even more because a lot of it's taken out of context. And they come in and they're like, okay, this is what I got. I got this over here, this over here, this over here. Okay, well, the first thing I'm going to recommend is that we set up we try to bring everything we can into one thing, into one place. And I've got vendors that I like that actually make an extension, that have software that allow you to track stuff that's outside of them, so that if you didn't really want to move it, you don't have to. And that's kind of cool. But anyway, I'm digressing. When you're looking at annuities, this is so funny that I get so far away from this. But right now, some of the better rates, these are good rates from companies that are rated A or higher. And because I don't like to use companies that don't have those high rates, the current rates are right around 5.6, and that's a 10-year guarantee. That's really a good rate over that length of time. And here's why I'm going to say this: the economy has been slowing down. If the economy continues to slow down, those interest rates on money market accounts, savings accounts, they're all going down. Those things go down quickly. As soon as the economy starts to slow down a lot, they're going to cut them a lot. And if you believe that a recession is coming and this would be a good time to be able to lock those rates in. And this one again, what is it? Yeah, it's 10 years. 10 years. So, and that's from a A-rated insurance carrier, which is, it's a pretty high rating for a company that's willing to pay 5.6% for the next 10 years. And but maybe 10 years is when they guarantee that for 10 years. Incidentally, normally there is a penalty period. It'll be anywhere from 8 to 10 years if you took it out. If you took out more than 8 or 10% a year, which the vast majority of them have the free withdrawals. If you take that, you can take that much out each year without paying a penalty on it. And incidentally, when you go to take money out, that means 10% of it's not going to be paying that penalty. So you won't apply the penalty to the whole thing if you take it out the correct way. And I'm sure people's heads are spinning right about now. But believe me, I feel your pain. Trying to keep up with it is not easy either. So anyway, the higher rated companies for a period, this is the highest interest rate that's guaranteed for the longest time period. Typically, your highest interest rates are only guaranteed for 1 or 2 years. So I wanted to get a long one. The longest quality company out there that I see right now is paying 5.6. And again, if you don't need it now, just let it compound inside of the policy, and you don't get a 1099 on it. You don't have to claim it and pay taxes on it. That's a big deal. So if you have any questions about that, feel free to give me a call. I can go over it for you. If you have old annuities out there that you would like to have reviewed, there's no charge for us to review it. I would ask this, that you get the most recent statements. You give me a statement that's more than 3 months old, it's not any good. So, because things change. So get the most recent statement, give us a call. We'll be glad to work through it with you, shop it around, see if it might improve. Oftentimes, I'd say probably half, one out of two. There's something out there that might be better, but that means that there's 1 out of 2 where, you're not going to be able to improve on it. You've got a pretty good deal right now. So, and we'll let you know that. That's not a problem. Anyway, I got about 60 seconds before I got to get out of here. My name is Bill Bullington. I'm here every Saturday morning from 11 to noon. Feel free to give me a call. I feel bad I didn't talk more about stocks today. I promise I'll put at least 20 minutes on the clock next week, next Saturday morning. In the meantime, have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not